Hello everyone, my name is Yogesh Bhandari and I am a chartered accountant by profession. Today in this presentation we are broadly going to discuss about finance, where we will cover introduction to finance, financial market and securities market, risk and return. Let us go through that. Before understanding the word finance, we need to understand the objective of man behind the finance, who is a finance manager. An objective of the finance manager is to maximize the wealth of the shareholder by maximizing the value of the firm. And an increase in shareholders' wealth is reflected by increase in market value of the firm. Now we need to understand the factors that affect the value of the firm. So in this diagram you'll get an idea about those factors which contribute towards increase in value of the firm. So which are measured by financial results like profits, earning per share, cash flows. However, there are various non-financial parameters that contribute to the value of the firm. These are robust business model, sound management team, strong competitive advantage, contribution to society, and much more. These parameters eventually contribute to the profits and cash flows, but their effect may not be immediately visible in the financial results. Now that we have understood the objective of finance manager, we need to see his roles now. To put things in a scenario, the key decisions taken by a finance manager revolves around the following factors. Those are: number one, investments. A finance manager should always be aware about where to invest. Example, plant or machinery, any new acquisitions that need to be made, any new business unit that need to open. Another factor is resources needed. Here, the question that finance manager need to address is, what is the amount of initial investment that is required? What is the working capital requirement of the company? That is the amount needed for managing daily operations of the company. Another factor is funding sources. How the amount will be funded. Whether there will be a long-term sources, whether there will be a short-term sources, whether there will be equity or debt in a long-term sources, or some internal operations or short-term loans will be taken in short-term sources. So those are the questions that need to be addressed over here by finance manager. Another factor is controlling. A finance manager should always ensure that the investments are managed in the right way to achieve the stated financial goals. Now that we have understood the role of finance manager, let us go through the key functions performed by finance manager. The key functions and responsibility of the finance manager are estimating the requirement of funds, both short-term and long-term, decisions regarding capital structure of the firm, debt and equity mix has to be taken care of, any funds infused into the company by way of debt or equity has to be optimally utilized. He is also responsible for all the investment decisions taken in the company. He has to carefully analyze the new projects or new business undertaken by the company. If required, he has to perform the exercise of capital budgeting. He has to ensure that the returns are greater than the cost. Another key function is dividend decisions. He has to decide about how much to retain and how much to pay as dividend. He is also responsible for evaluating financial performance of the company, the returns that the company is getting, their monthly, quarterly, half-yearly and annually performance of the company has to keep a check on. He is also responsible for the financial negotiation with the bankers and financial institutions for any new loan or for any reduction in rate of interest. He's also responsible for management of cash. Working capital requirements of the company has to be taken care of. He has to keep a balance between the liquidity and excess cash in the company, if any. He is also responsible for keeping in touch with stock exchange in order to keep compliance with respect to Companies Act and SEBI, etc. So now we will discuss about financial markets and securities market. In the economic system, there are people with surplus funds and there are people with deficit of funds. The financial system functions as an intermediary and facilitates the flow of funds from surplus areas to deficit area. The financial markets play an important role in the efficient functioning of financial systems. Financial markets are divided into primary market and secondary market. The primary market serves the purpose of raising funds in the form of new securities, such as initial public offering of shares, issue of bonds or debentures in the market. In this market, the issuer of securities comes in close contact with the buyer of securities. The secondary market facilitates the existing securities to change hands among investors. For example, when you buy shares of the company on the stock exchange, you are basically dealing in the secondary market. We have come to the most important topic of this presentation, risk and return. We need to understand the objective of an investor behind his investment. The objective is to maximize the return from the investment, subject to various constraints, primarily risk. Now we need to analyze return. Returns are majorly realized or expected, either of these two things. And the rate of return is the total return the investor receives during the holding period, stated as a percentage of the purchase price of the investment. Generally, the equation for calculating rate of return is this, wherein dt is the income or cash flow from securities during the holding period. Pt is the price of securities during the holding period. And Pt minus 1 is price of securities at the beginning of the holding period. So in the numerator, amount which is total received or total income from an investor is mentioned. And in the denominator, purchase price is mentioned. And that's how rate of return is calculated. Now we will see risk. Risk can be defined as a chance that the actual outcome from an investment will differ from the expected outcome. Risk and return go hand in hand in investment and finance. Risk and return are directly related to each other. Higher the risk, higher is the expected return. Now, we will see diversification of risk. One of the most frequent method for reducing risk is by diversification. That is, investing in the group of securities rather than specific stock. In an efficient market, a risk-averse investor can achieve more secure investment by investing in combination of securities of different companies, preferably of different industries. Hence, in order to reduce risk, investor holds a diversified portfolio, which might include equity, bonds, savings accounts, real estate, bullion, and so on. And that is how an investor should not keep all his eggs in one basket. Now, we will go through the type of risk. Interest rate risk is the variability in securities return due to changes in interest rate. Market risk is the variation in return due to fluctuation in securities market. Inflation risk is a risk associated with the changes in prices of all commodities. Business risk is a risk associated with different activities undertaken by the enterprise. Financial risk. This risk is resulting from the existence of debt in the capital structure of the company. Liquidity risk is a risk associated with secondary market in which the security is traded. Systematic risk. Now this risk is very important to understand. Systematic risk is the risk that affects the entire market and hence the firm too. This is also called non-diversifiable risk. So which is, even though you use the tool of diversification of risk, this risk is something which is inherent. Unsystematic risk. Last. Unsystematic risk is the variability in the securities return on account of the firm's specific risk factor. It is also called diversifiable or avoidable risk. Now we come to the last topic of this presentation, beta, which is also associated to risk. If a portfolio is well diversified, the unsystematic risk gets almost eliminated. What is important for an investor is to understand systematic risk. The systematic risk arising from the wide movement of security prices in the market is very important to an investor. The modern portfolio theory defines the riskiness of a security as its vulnerability to its market risk. This vulnerability is measured by the sensitivity of the return of the security to the market return and is called beta. Thus, beta measures non-diversifiable risk or systematic risk. It shows how the price of the security responds to the market forces. The beta of the overall market is said to be 1. For example, if the market return is 20% and return for a particular investment moves up or down by 15%, the beta of the investment with respect to market is 0.75. I hope this presentation was useful and value addition for you. With this, we have come to an end of this presentation. Thank you. Thanks a lot.